Hey traders and investors, it's Serge Berger here. Let's have a look at the S&P 500 again. I got a lot of questions over the weekend regarding the S&P structure. Some people very bearish, some people undecided, and a few minority of the comments somewhat bearish. Um, Let me just quickly say this. In terms of the subscribers and what I've done in the funds that I manage in portfolios, we've stuck to the long side. About 40% invested, 30% invested, something like that, a lot of cash. Why? Because of the following pattern in the S&P, among other things, of course, but I'm giving you the technical view. So the S&P 500, or general U.S. stocks being led by the Dow, large to ultra to mega caps, leading to down a late cyclical bull market. That's not the kind of thing where I want to short the lows of any market. So, in other words, if you look at the S&P here, still making a series of higher lows, and looks like today so far, at least, trying to make potentially a higher high. This is conducive to a higher high, which is what we're seeing here today. You can see the stock market right now. It's Monday morning, around 11:30 a.m. Eastern. You can see the move here fairly bullish, actually very bullish, and if it sticks, right, it's got to stick. But basically, the pattern in play still is this sort of inverse head and shoulders pattern that I've discussed here before. I need to stress it because a lot of people sort of, didn't really take it as a serious signal. These kind of things aren't to be taken serious unless you really look at them closely, right? So what we need to do is look at these developments very closely using candlesticks, and that's how I really most of the time get my ultimate trade signals. So if you look at the S&P, you can see as this inverse head and shoulders pattern, or whatever you want to call it, it had a bullish tone to it in many ways, particularly as over the past couple of weeks we rejected the 50-day moving average twice with these long bullish tails, where you can see on these days, once on the 28th of April and then again last week on the 7th of May, rejecting it on a daily closing basis, this yellow 50-day moving average. And today we're getting an up gap, rallying past last Thursday's lousy rejection lower market. And then on Friday, by the way, also a bullish pattern here off the 50-day again, closing at the highs of the day, leaving a long bullish tail with a sort of hammer type of candle. So we've now had quite a bit of reasons to take this inverse head and shoulders pattern here quite serious, particularly because of these long rejection candles. So if you look at that, and then you look at something like the IWM, which is the Russell 2000 ETF. A lot of people were sort of crying wolf last week, saying that we broke the 200-day. That's this red line. Asking me why I'm not shorting the market. And I said, listen, guys, if you have divergence like this in the S&P, when you get an overbought, an oversold rally, it's going to be nasty, and it's going to be calling for it's going to cause a lot of shorts to really sort of get their face ripped off in a very short period of time. And quite frankly, with the move here that we're seeing so far in the Russell, again, we need a positive close today. We can't have any more of this wishy-washy kind of rejection and falling apart in the afternoon kind of price action. But if we get a strong close, the S&P 1920 to 1970 remains my upside target through the medium-term lens. Hope this makes sense, guys. As always, if you want to look at the trade alerts in real time, go to steadytrader.com. Otherwise, you can hit me up on Twitter. My Twitter handle is steadytrader. Take care.